Welcome to The Explainer. Today, we're setting out to master one of the most precise, high-probability institutional trading concepts you'll ever find on a chart. We are decoding the balanced price range, or BPR. If you've ever felt like your standard trading setups leave you completely exposed to random market noise, or if you just want to finally understand how institutional order flow actually stabilizes, well, you are in exactly the right place.
Okay, let's dive right into this. Have you ever wondered what exactly happens when absolute market chaos meets a brick wall of opposing force? I mean, we all know the pain of getting stopped out on standard setups during crazy high volatility, right? Sitting there wondering how the algorithms seem to know exactly where our stops were hiding. But what if there was a way to find the exact eye of the storm? That split-second moment when aggressive buyers and aggressive sellers totally neutralize each other, leaving this highly structured footprint that we can actually trade from.
Here is our quick roadmap for today. We'll start with market balance, define the BPR, compare it to the standard FVG, look through the institutional lens, map out the BPR trade flow, and finish up with some common pitfalls.
All right, kicking things off with Section 1, the quest for market balance. There's a well-known saying that the market constantly seeks to balance buy-side and sell-side price delivery, and that's really the core of it. For a market to be truly efficient, the algorithm has to offer a two-way flow of orders. We need buying and selling opportunities at every single price point. When price is delivered efficiently, we get those nicely overlapping candlestick wicks and continuous order matching. But let's be real, the market isn't always efficient, is it? When major macroeconomic news drops or institutions suddenly flood the market, price gets delivered way too rapidly in one single direction.
When that massive displacement happens, the market literally skips over price levels. So we need to quickly establish our baseline here, the fair value gap, or FVG. It's essentially a single-sided inefficiency. You're looking at a three-candle sequence where price moves so incredibly fast that the first and third wicks just do not overlap. It leaves a literal gap, an unfilled space on the chart where only buyers or only sellers got to participate. It's a one-sided imbalance that, eventually, the market usually wants to revisit.
Moving right along to Section 2, defining the balanced price range.
Now, what's really interesting here is how we define a balanced price range. It is a specific price zone where two opposite fair value gaps overlap horizontally. Think about what that actually means in real time. The market moved super aggressively in one direction, leaving a massive imbalance, and then almost immediately aggressively counter-displace, leaving an opposing imbalance right on top of it. This overlap completely neutralizes a highly inefficient zone, turning it into a structured temporary equilibrium. Basically, both sides have unfinished business right there.
Let's break down the candlestick anatomy for this. For a bullish BPR, you'll first see a bearish FVG, representing heavy selling, which is then immediately overlapped by a bullish FVG as the buyers surge right back in. A bearish BPR is literally just the exact inverse of that, a bullish FVG overlapped by a bearish FVG on the way down. The absolute crucial takeaway here is that the exact horizontal intersection of these two gaps, not just the broad general area, but that precise shared overlap, is your highly sensitive entry zone.
Which brings us to Section 3, BPR versus FVG.
And this brilliantly illustrates the vast differences in implications and reliability between these two concepts. A standard FVG is just a single-sided inefficiency. Sure, it gives you multiple entry levels throughout the day, but often with a much lower win rate, because you're really only looking at one half of the story. The BPR, on the other hand, is an area formed specifically when opposing fair value gaps overlap, creating this powerful two-sided inefficiency. It demands incredibly strict, narrow entry conditions. Because both the buy-side and sell-side imbalances intersect in that one spot, the BPR serves as a much stronger magnet for price.
To put that into perspective, just look at this specific win rate, 60 to 70%. Our sources show that a strict BPR execution, when it's properly aligned with your daily bias and market structure, boasts a win rate right in that 60 to 70% range. You can often target a 1 to 2 or even 1 to 3 risk-to-reward ratio. Now, you will absolutely see fewer setups than you would with standard FVGs, simply because the criteria are so much more demanding. But honestly, when they do print, particularly on highly liquid assets like US index futures, the precision and those sharp immediate reactions are truly unmatched.
Let's shift our perspective a bit in Section 4, the institutional strategy lens.
So, why does smart money actually care so much about these overlapping zones? Well, three main reasons. First up is imbalance mitigation. The algorithm just has a natural tendency to want to return to and fill those residual inefficiencies left by the gaps. Second, we have structural mitigation. Institutional participants who got trapped on the wrong side of that initial rapid move, they need to mitigate their risk at break-even, and that generates a massive surge of order flow. And third, double attention. Because you literally have two gaps sitting at one exact price, smart money is positioning from both directions simultaneously.
So the absolutely crucial point here is this golden rule. Never look for a buy setup in a premium zone, and never look for a sell setup in a discount zone. Think about it like a giant measuring tape. If you draw your dealing range from a major swing high down to a swing low, that 50% line right in the middle is your equilibrium. Anything above that line is premium, meaning it's expensive. Anything below is discount, meaning it's cheap. If you try to force a bullish BPR buy setup while you're sitting up in a premium zone, you are quite literally just providing liquidity for the institutions that are looking to sell. You absolutely must use that 50% equilibrium line to filter your setups.
Moving into the execution side of things, Section 5, the BPR trade flow.
Let's see how this builds into a highly structured, repeatable flow on your charts. Step 1, set your daily bias. And above all, exercise patience. Wait for price to tap a higher time frame point of interest. Please don't preposition. Step 2, drop down to a lower time frame, maybe the 5-minute, and spot a clear market structure shift in the direction of your bias. Step 3, identify your overlapping opposing fair value gaps right there at the origin of that structural shift. And finally, Step 4, execute your trade exactly on the retest of that intersection, placing your stop safely past the recent swing extreme, just leaving a tiny little buffer. This right here is your repeatable blueprint.
Almost at the finish line, Section 6, navigating common BPR pitfalls.
Because knowing the setup just isn't enough, right? Avoiding the traps is where your real edge lives. Let's rapidly run down a few common mistakes that trip traders up. First, trading near misses. The gaps absolutely must overlap horizontally. Close enough just doesn't count here. Second, stacking two bullish or two bearish FVGs. Guys, that's just a bigger gap, not a balanced range. They must be opposing. Third, placing stops way too tight, like just 1 pip past the BPR boundary. If you do that, you're going to get spiked out on a standard retest. Put it safely past the swing extreme. And finally, forcing BPRs in nowhere zones against the daily bias. If you aren't anchored to a higher time frame narrative, you are literally just trading random geometric shapes.
We've covered a massive amount of ground today, going all the way from macro market efficiency right down to exact institutional entry criteria. Which brings us to one final, pretty provocative question. Are you trading the imbalance, or are you waiting for the equilibrium? The balance price range rewards immense patience. It basically asks you to wait until the storm of opposing forces completely neutralizes into a calm, high-probability zone before you finally strike. Take this refined lens, go map out those overlaps on your own charts, and just see what the market reveals to you. Thank you so much for joining me on this explainer, and as always, keep learning.